Last month, exactly 25 years after predicting the dot-com bubble, Howard Marks posted a new warning to investors. This new memo is trying to answer the question that's on every investor's mind. Are we in an AI bubble? And to answer, we'll define what a stock market bubble is, why it appears, and what to do when a potential bubble is brewing. In recent years, a small number of stocks dominated the S&P 500 and have been responsible for a disproportionate share of its gains. The market capitalization of the 7 largest components of the S&P 500 represented 33% of the index. Prior to the Magnificent Seven, the highest share for the top 7 stocks was 22% in 2000, at the height of the internet bubble. It's also important to note that at the end of November 2024, US stocks represented more than 70% of the MSCI World Index. It is clear that US companies are worth more compared to their peers from the rest of the world. But are they in a bubble? Since bubbles always start in bull markets, Howard Marks lays out the 3 stages of a bull market. A bull market starts when the market is recovering on the heels of a decline. Here only insightful people can predict the improvements ahead. Then the second stage is when markets are doing well and most people see the economic improvements and join the stock market. Lastly, the third stage is when companies are doing well, earnings and stocks are growing, and everyone believes that things can only get better. And if everyone believes things can only get better, the good news will be priced in, and it becomes difficult to find undervalued stocks. So Howard Marks argues that bubbles are characterized by bubble thinking.
You know, psychology is by far the dominant influence on investing in the short run. It has very little to do in the short run with fundamentals.
And this is obvious from the widespread participation in the investment fad of the moment, especially from non-financial individuals.
That a bubble is not a period of rising prices, it's a period of temporary insanity. To me, the important thing is not the stretch valuations, it's how they got there. And it's through this loss of objectivity.
But what could get investors to a point where they're not thinking clearly anymore and they're willing to risk their hard-earned money? The thing that makes investors lose their composure is new developments. This is why the phrase "this time is different" often appears. And that's how investors could get away with crazy valuations. There's no history, so there's nothing to temper the enthusiasm. But the problem is that all the bubbles in recent history involved innovations which were either overestimated or not fully understood. For instance, in 1999, investors were sure that the internet will change the world. And eventually the internet did change the world. So usually there is a grain of truth that underlines every mania. It is just that it is taken way too far. So after witnessing the biggest bubbles in history, Howard Marks came with a few guiding principles that carried him to the next 50 years. Firstly, it's not what you buy, it's what you pay that counts. The price of what you pay for a stock matters. For instance, if you bought Tesla in 2021, even if it is a great company, right now you would make a profit of 0% in 4 years. Lastly, there's no asset so good that it can become overpriced, and there are few assets so bad that they can't get cheap enough to be a bargain. Meaning, don't buy something just because it's cheap, it can always get cheaper. Now that we know his guiding principles, let's see his predictions for 2025. When looking forward at 2025, Howard Marks cites a quote that guided him through his investing career. When investors forget that corporate profits grow about 7% per year, they tend to get into trouble. If corporate profits grow at 7% per year and stocks appreciate at 20%, eventually stocks will be so highly priced relative to their earnings that the risk will be very high. Actually, there were only 4 times in the history of the S&P 500 when it returned 20% or more for 2 years in a row. In 3 of these instances, the index declined in the next 2 years. And in the last 2 years, it's happened for the 5th time, with the S&P 500 up 26% in 2023 and 25% in 2024, for the best 2-year stretch since 1997. That is why Howard Marks issued some cautionary advices for 2025. He argues that the optimism has prevailed since 2022, with large enthusiasm for AI. Moreover, there's a belief that the top 7 companies will continue to be successful. Moreover, as a side note, Howard Marks warns about Bitcoin and the fact that its price rose 465% in the last 2 years doesn't suggest an overabundance of caution. Lastly, he presents this phenomenal graph from JP Morgan. It shows that there's a strong relationship between the valuation at which you buy and the subsequent annualized 10-year return.
JP Morgan published a table at the very end of the year which showed that if you bought the S&P at today's PE ratio, any time between 88 and 2014, you made between -2% and 2%.
This is very important, and it shows that higher starting valuations consistently led to lower returns, and with the current S&P 500 PE ratio of 22 times, he concludes that investors should clearly be aware of today's market valuation. But on the bright side, while the PE ratio is indeed high, it is not at an insane level. The Magnificent Seven are indeed incredible companies, and the narrative that no price is too high is not common today. That's why Howard Marks admits that investors could use a defensive strategy, but we shouldn't necessarily leave the market.
I think we would agree that U.S. stock valuations, for example, are on the high side relative to history. That would tell me to be a little less aggressive than usual, a little more defensive, but not necessarily to get out.
Moreover, he argues that diversifying with bonds might be a compelling investment at these levels.
So today, high-yield bonds offer 7.3%. Then you look at the S&P, which historically has returned 10 for the last century, and Goldman Sachs came out at the beginning of November and said over the next decade, stocks will make 3. So if you can get low single-digit returns from the S&P with great uncertainty and 7.3 from high-yield bonds contractually, isn't it better?
However, there is one last metric that screams high risk. Actually, I'd argue that this is where the risk comes from, and it is obvious in this graphic. These are the R&D investments made by the Magnificent Seven, and the trend is only getting stronger as companies are forced to invest into AI or get left behind. Together, the Magnificent Seven will invest over $300 billion in 2025, and then 300 more. But Warren Buffett recently told us how difficult it is to get a good return on investment on his $300 billion cash position. So if these companies will not see the expected returns from these massive investments, then the stock market is in big danger. That was it from me. If you want to see a more positive outlook on the 2025 stock market, you can watch this next video.